In our first video, we went through specific transactions for family health care related to the activity that was taking place during the month of June. What we ended up with were specific balances, and these balances are before the adjusting entries. So as an example, based upon the journal entries in June, before our adjustments, we have cash of $7,100. As an example, land is $12,000, accounts payable is $6,700, retained earnings is $10,200. We talked about this concept of unearned revenue. That is $1,800. The unearned revenue, if you recall, was when a person actually paid the organization, paid family health care in advance for the use of the land for the next 5 months. Given the fact that we have accrual-based transactions, we now need to go through the process of doing specific adjusting entries. And I want to talk about each of these adjusting entries individually so that we get a sense of what these actually mean. In our first adjusting entry, what we see is that the equipment depreciation is $500 for the month of June. Well, let's talk about depreciation. In the month of June, during the month of June, we purchased $7,200 of equipment. This equipment is an asset. However, this is an asset that we consume. And what we mean by this is that over time, the value of the asset decreases. As the value of the asset decreases, we capture an expense. The way we set this up in our accounting system is we set up what we call a contra account. The contra account is accumulated depreciation, and then we have a depreciation expense. So in this case, we have a contra account of $500, which is a negative value, and our depreciation expense is an expense, and it actually is going to reduce our retained earnings. So let's talk about this contra asset. So this contra asset is accumulated depreciation. You notice that it is a negative number, but it is reported on the asset side of the balance sheet. When we complete the balance sheet for this organization, what we're going to be doing is reporting the net value of assets. Net means the cost minus the accumulated depreciation. So for the month of June, we have the cost of $7,200 minus our accumulated depreciation. Therefore, on the balance sheet, the asset of equipment is going to be reported at the net. One thing that I will point out is that land is $12,000. Land is not depreciated. So that's why we don't have a depreciation or an accumulated depreciation for our land. In the next transaction, we're looking at our supplies. During an inventory count at the end of the month, Family Healthcare had $150 of supplies remaining on the shelves. Supplies, very similar to inventory, and we're going to be talking about inventory as we progress through this class, but supplies is an asset, and the asset is consumed. As we consume the asset, we have what's called a supply expense. So I have a basic formula here that I want to go through and make sure that we understand what's taking place. So our supply expense, which is what we need to calculate, is our beginning balance plus any purchases that we had during the month minus our ending balance, and that's our supply expense. So let's look at supplies. At the beginning of the month in June, we had a supply balance of 0. During the period, we purchased $300 of supplies, and at the end of the period, we had $300 in our pre-adjustment balance. We then do a physical inventory count, We physically counted the inventory and it's $150. Therefore, the difference between what we have, which is $300 minus the $150, then becomes an expense. So what we're going to do in this transaction is we are going to reduce our supplies by $150, and we now have a supply expense of $150. And again, it's a negative number in retained earnings because expenses are a reduction in our retained earnings. So we have a reduction in supplies. We have a supply expense. Again, we're going to see the same formula when we start looking at inventory. Let's look at the next transaction. So in the next transaction, what we are doing is we are accounting for the fact that 1 month has expired since this other organization prepaid the rent for the land for the next 5 months. So we had originally a balance of $1,800 in unearned revenue. What we stated is that over time, we are going to be accounting for the earning of this revenue, and the earning of this revenue is going to be a reduction in unearned revenue and a posting to retained earnings as revenue. So in this case, what we have is 1/5 of the $1,800. So we're going to reduce unearned revenue by 1/5. So this is going to be a reduction. So it's $1,800 divided by 5. So it's a reduction in unearned revenue, and corresponding to that is going to be an increase in retained earnings because we actually have revenue. Let's look at the next transaction. The next transaction is related to prepaid insurance. If you recall, during the month of June, we purchased 2 insurance policies, an $1,800 policy and a $3,000 policy. When you buy insurance, you have what's called a prepaid expense. Insurance becomes an expense as it is consumed over time. So what we have determined is that over the month of June, $1,100 of the insurance has expired. So what we're going to do is we are going to reduce the prepaid insurance by the $1,100, and corresponding to that is we now have an insurance expense, a reduction in prepaid insurance and an insurance expense. And again, it's an insurance expense, which is a reduction in retained earnings. The next piece that we want to talk about is specifically related to what we call wages owed but not paid. Let's walk through the scenario. So the scenario is that we do a payroll run every 2 weeks. By chance, and this usually actually occurs every month, is pay date does not occur on the exact end of the month, which means that, let's say the next payroll run was July 3rd. When we issued the July 3rd payroll, we are going to be accounting for some of the payroll that reflects expenses in the month of June. So preemptively, what we want to do is we want to account for the expense, and the expense here is $220, but we're not actually paying for it. We're simply creating a wages payable. So in this case, what we have is we have a wages payable of $220, and corresponding to this is we have a wages expense of $220. So what you see here is that everything actually occurs on the liability and stockholder equity section. We increase the wages payable, which means that we owe this. We're going to pay this on the 3rd of the month when we do the payroll run, but we are accounting for the part of the wage that is the expense for services that were provided during the month of June. So now what we have is we are able to create the ending balances after the adjustments. Now we're not doing this in this video, but what we're going to be able to show in the next video is how these balances then get converted into the financial statement information. So let's make sure that what we have is within balance. So let's do a sum, and the sum is going to be these cells here. And so what we have is we've created from the beginning, which is the balance before the adjustments, and all the other entries of the adjusting entries. Let's then scroll this over for the assets. Scroll this over for our liabilities and stockholder equity and see what we have. Well, cash did not change, neither did accounts receivable. There were no adjusting entries related to those accounts. But you notice how the prepaid insurance, before the adjustment, we had $4,800. We had an $1,100 adjustment specifically related to the fact that some of the insurance has expired. Our supplies, as we stated, we did a physical inventory count and the ending balance was 150. So the difference between the ending balance and the balance before the adjustments is our supply expense. So we created a reduction in supplies, and corresponding to that is we have a supply expense. The equipment balance does not change. This reflects our cost, but corresponding to this is we have a contra asset. This contra asset reflects the consumption of this asset through our accumulated depreciation. So the accumulated depreciation reduces the asset value, and corresponding to that is we have a depreciation expense. A couple of the other transactions that we talked about relates to our unearned revenue. If we recall, at the beginning of the period, a company rented our land for the next 5 months and paid us in advance. Because we had not earned that revenue yet, we created a liability, which we call unearned revenue. Since it's 5 months, 1/5 of this has been earned during the month of June. Therefore, we are reducing unearned revenue by $360, and corresponding to this is we have revenue earned of $360. We've talked about the insurance expense, again, reduction in prepaid insurance and our insurance expense. And the final item relates to the fact that we have wages owed but not yet paid. They're going to get paid in the next couple of days after the beginning of the month, but embedded in that payment are work days that occurred during the month of June, which we need to account for. So let's just make sure that the numbers actually equal. So the assets you see is $36,950. Our liabilities plus stockholder equity is also $36,950. So we are in balance. Now that we have the balances after the adjustments, we're now going to be able to create the balance sheet, the statement of stockholder equity, and the income statement. I thank you very much for your time, and I'm looking forward to talking to you in our next video.